Welcome back to my channel. In this video, I wanted to cover Amazon and see what's going on with this stock and with the company. The company's stock is down 17.5% year to date. It's really been on a slide. And I wanted to see, is this an opportunity to buy this great business? Or is it a sign that there's something wrong with the company and I should be very cautious with this stock? I'm currently an Amazon stockholder. And in this video, I'll arrive at a conclusion of, should I buy more shares, hold my shares, or sell my shares in Amazon? The business over the past year, they are doing really well. And Amazon's the type of company that they don't necessarily focus on their stock price. They really focus on their business. They obsess on the customer and really just want to continue to make their business stronger and better. And they certainly have done so. Their businesses are very strong in cloud computing as well as the e-commerce businesses. They're just the leaders in their respective industries. Over the past year, the stock is down 1.35%. Over the last 5 years, the stock is up 52%, which is not that great. It's actually underperforming its peers that are about the same market cap. So there is enough there to be concerned. Is this a sign that Amazon is not going to return this type of appreciation that, let's say, Meta has been appreciating at, or even smaller caps are rewarding stockholders at a higher rate? Let's take a look at the fundamentals. Amazon is a $1.9 trillion market cap company. It's a big, big market cap, but so is their revenue. Incredibly, there's $638 billion in annual revenue. They are the biggest revenue company in the United States now. Forward PE is 28.46. That is high. Analysts believe in the company. They believe it's discounted. The financials. When we look at growth, the growth is very impressive. Considering they're so big and they still grow at 11%, to me, that's very impressive. They continue to expand, have customers buy more product on the e-commerce side, or on the AWS business, they continue to have customers consume more cloud. That looks super impressive. Now, the margins are not like a software company because they have that e-commerce business, but even with an e-commerce business, 48% margins look great. They do produce free cash flow. Now, that's one ding that I would say they deserve is they have spent a lot of money in the data center with capital expense, and that is risky. If that amount of cloud infrastructure doesn't get consumed and it's just sitting there and it's idle capital, that'll hurt the business. So I think that's one of the actions that the company's taken that stockholders do not like. And we'll see when they announce their earnings if they're reducing the amount of capex, which would, if they decrease capex, it'll improve the free cash flow number and would get the stock maybe to rally again. The margins look okay considering they're predominantly an e-commerce business. And overall, just a really strong company. EBITDA margin, 18.88%. They have expanded that EBITDA number very impressively. Again, their scale of their business is massive. They're bigger than Costco. They're bigger than Walmart now. So it's really impressive to see them grow their business. Many analysts cover the stock, 45 of them. They believe collectively, on average, that this stock is discounted by 42%. And the most optimistic analyst believes this is a $300 stock, and the most pessimistic analyst believes the stock's discounted. So everybody thinks Amazon's worth more, but the stock's trading down. In the current year, they're expecting to continue to grow. I just can't tell you how impressed I am. This is a massive number of revenue, and they keep growing it at a very, very good rate. Incredible. And they're going to grow their earnings per share. So these numbers look really, really good, the earnings per share numbers. All right, so let's take a look at a valuation now. Let's determine what the intrinsic value is of Amazon. So when I look at Amazon and look at the free cash flows companies producing, create a free cash flow forecast for the business, and then discount that free cash flow forecast by a logical discount rate of 8%, I get to $1.4 trillion of value. I add cash and take away debt, and I arrive at $1.4 trillion of value. And the market cap for the business is above that. it's at 1.9 trillion. So when I compare the intrinsic value of free cash flow that I expect Amazon's going to produce, the stock is being sold at a premium of 25%. So the sell-off in the current year has been making the stock bringing it down closer to intrinsic value. The one thing I would say is if you looked at my forecast of cash, let's say 6 months ago, before they started to spend so much in the data center, I had a more favorable forecast on free cash flow and actually had the Amazon stock maybe 6 to 8 months ago discounted by maybe 20 to 30%. But that change in free cash flow really changes the value of the business. And I think other investors are looking at that and reassessing Amazon, revaluing Amazon. Even at this new lower stock price, I think the stock is still priced at a premium of 25% when I compare the stock to the intrinsic value of the cash flows of the business. The earnings per share look great. And I think the stock's actually priced fairly when it comes to earnings per share. But collectively, when I average those two, and I should say I blend them, I don't average them, and I take more weight in free cash flow, less weight in earnings per share, I think the stock's priced 16% too high still. So where do I put Amazon in my desirability quadrants? Well, it's very easy to put Amazon clearly in the green. Now, what makes the most desirable businesses to me are businesses that have very good moats, barriers of entry. And when I look at Amazon, they've got their e-commerce business is so far ahead of everybody else. Their network power, their scale, the platform, all those things clearly put a giant moat around that business. And when we look at the AWS business, same thing. They have become the biggest cloud services company in the world. And it's very hard to switch over from clouds. If a company goes to Amazon and develops on Amazon, takes their workloads to Amazon Web Services, it's very hard to switch over. So that's a very strong moat. When it comes to revenue growth, profitability, and free cash flow growth, same thing. I think Amazon has the ability to really improve their cash and really improve their profitability. They just choose not to do it. They don't necessarily obsess on their stock price. They obsess on their customer. They obsess on their business, trying to make it better. And that's what I believe they are doing in the current time. Nonetheless, I think the stock is priced a little too expensive, as mentioned, by 16%. So I'm going to hold my Amazon shares. I'm not going to sell them. I'm going to hold and wait for the stock to improve. I think as we see earnings, their management team's top notch, and they're going to listen to the concerns of the stockholder. They're going to realize that, hey, maybe they are growing that data center a little too fast. We are destined to go into a recession. And I don't know how much consumption of that data center is going to happen. Maybe they might even see a contraction. We'll see. So again, Amazon's a great business, but it is a hold on Amazon right now. If I didn't own Amazon, I would not be buying it. And that's another way of answering that question. Is it a buy, hold, or sell? It's more of a hold with no additional buys. So that's my review of Amazon. I hope you found it interesting. Let me know what you think of Amazon. Thanks for watching. Good luck with your investments.